Thanks again, and thanks again everyone for being with us, especially those waking up at a very early hour. Glad you can join us. Again, today we are focusing on moving averages, and I'm going to start off by talking a bit about the different types of moving averages that are out there. We're going to talk about some of the pros, some of the cons, and more importantly, how to trade with them, both for the short term and the long term. And then a few ideas on combining them with other indicators, and not just other indicators like, the CCI or the RSI, but maybe combining the different types of moving averages. You'll find that there are advantages to that as well. And of course, Q&A, very important piece here. By all means, ask away. Anything you want to ask throughout the session, we'll keep an eye on the questions and interrupt me if necessary. This is all for you. So if you've used moving averages in the past and have found it difficult for whatever reason, by all means, let us know what you find difficult, and I'll try to help you with that. If you found a very useful way to trade with moving averages, if you don't mind sharing with the group, I'm sure everyone would appreciate it. So by all means, let's make this an interactive session, and let's spend the next hour exploring moving averages. So let's get to it. Please do remember that trading can be risky, so please don't trade with real money until you are completely comfortable with the system you are using. Now let's talk about moving averages. So the different types of moving averages. There are many. Now, we're only going to focus on a few here, but if you look at this list, hopefully you can see it. These are all the different types of moving averages that are on part of the Thinkorswim platform, and these are on most trading platforms. But they range from a simple moving average, which is basically just counting back a certain number of bars, adding them up, and dividing by that number. So if we, for example, were to take a 10-period moving average, what it would do is go back 10 bars and plot the average price of the past 10 bars, right? Just a simple moving average. Then there's what we call an exponential moving average, which puts a little more weighting towards the more recent candles. We also have a weighted moving average, which has a slightly different calculation, but is the same sort of thing. And then we have some moving averages that are not very common, like the Hall moving average, but can be very effective. I'll show you that in a little while. We have what's known as a displaced EMA or moving average, and we have ribbon studies. All of those things, again, if any of you have used them in the past and have found an effective method, by all means, share it with the group. I'll do my best to share as many ideas as I have with them. And also, which moving averages you prefer to use. This, I think, is the biggest question out there. And one of the things that most traders spend a lot of time on. We all search for the Holy Grail. And for most traders, they always try to find the perfect moving average. Is it the 8-period? Is it the 20? Is it a simple? Is it exponential? Is it the 50, the 100, 200? The number I'll show you in a second doesn't really matter. It only matters from the perspective that, how many people other than you are looking at that specific moving average period. That's what it comes down to. Okay, and that's why there are some very common ones. But otherwise, moving averages, the actual number doesn't really matter. And let me show you what I mean. I'm just going to put on here a simple moving average. Okay, we're going to go into the settings, and we're going to just pick a number at random. Okay, so I don't know. I'm going to pick 137. Okay. Let's try that. Let me see if I can put that in here, 137, and let's thicken this up a little so we can see it. Let's make it blue. Okay, so there's the 137 period moving average, probably one no one's ever used in the past, just a made up number. Now you can see since it's a fairly long-term moving average, and this is a trending stock, it's below the price most of the time here. Let's switch markets. Let's look at the Russell. Now you can see that we start seeing areas where price is starting to bounce off it, right? You can say, wow, that provided some support there. Let's look at gold or oil. Again, gold here, look at that. Price bounced right off the 137, did it again here. Let's look at oil. Yep, ran into overhead resistance. Again over here, found support here. So you see, you can put any number on a moving average, and you're bound to find a spot where price has approached it, bounced off it, broken through it, that sort of thing, okay? So the actual number isn't that important, okay? What it really means is, since this is a simple moving average, what it's doing is it's counting back 137 bars and plotting that average, okay? So obviously, the higher the number, the smoother this line is going to be, right? The longer it is going to take to change its slope, right? For it to, if it was pointing downwards, for it to start sloping upwards, you know, that it needs to see higher prices over a lengthy period of time, because it's going back 137 bars. So with one or two strong up days, it's not really going to change the moving average much, as opposed to if you had a much shorter time frame, right? So if we then go back here and say, let's leave the 7 period moving average now, okay? Right, there it is. It's going to follow price very closely because it's only looking back 7 days, right? Or 7 bars in this instance, okay? So it can move quite a bit depending on the movement over the last 7 bars, okay? So when you want a longer term trend, you increase the number on that moving average. When you're looking for something much shorter term, you lower that number, okay? Now, the time frame doesn't matter as much. You just have to keep in mind what you're looking at. So if I do the 1 hour, it's still counting back 7 bars. What that means is the past 7 hours, right? If I'm looking at a 5-minute chart, it's still counting back 5 bars, but now it's only the last 35 minutes in total, right? So you got to keep that in top of mind and decide how you want to use it. The other thing is that there are some very common moving averages, like the 20, the 50, the 100, the 200. These are moving averages that have always been very, very common and are used and looked at very often by many, many traders. So that's where moving averages become a little more important, right? We like to use the 20 period moving average, okay? And it tends to work very well. It's probably the most popular moving average out there. Now, I use it mostly for momentum, but there's a lot of eyes on the 20 out there. And so every time price approaches it, bounces off it, or breaks through it, people are taking orders based on that. So it becomes very important. Same with the 50, the 100, the 200. Those are your staples. Those are the ones that are the main ones. There are other combinations that are popular among traders, especially day traders, and I'll share some of those with you. But as far as popularity goes, the 8, the 10 is fairly popular. Again, more for day traders, but the 20, the 50, 100, 200 are your most popular out there, okay? Raul, I noticed we have a bunch of questions that have been typed in. Maybe we want to go through some of those before I go any further.
Sure. Sam, Katie, Texas was asking if we can spend a little bit of time on moving averages and futures. I think you'll get to that during the session.
There's actually, sorry, before you go on, there's actually no difference. Okay, so we can look at any market. We can certainly look at a futures market, like the S&P or any other. But as far as moving averages are concerned, you can be trading cocoa, you can be trading orange juice, you can be trading a currency, the Dow. It doesn't matter. It doesn't matter what you're trading. Same use.
You had put a question out there asking how our members are using MAs, moving averages. Brian in Denmark says, the 8 and 13 EMA, the way I use them is that the 8 must be above the 13, both trending up. If the price closes below the 8, I close half of my position. If the price closes below the 13, I close the entire position. It seems effective for me. Your thoughts?
Absolutely, and I would agree with you completely. And so we're jumping ahead a little, but that's definitely one of the things I want to cover. What are moving averages actually used for? So you know that I use the 20 for momentum, to judge momentum. But another thing that they're used for is as levels of support and resistance. So like Brian is using it, when it breaks the 8, he's considering that as the first level of support broken. He's exiting half his position. Once the 13 gives way, he's out completely. Okay. And so that's another very effective way to use it. So the slope and for support and resistance, those are the two main things that you want to use moving averages for. Again, the number doesn't matter. It really matters as far as how active you want to be, okay, or how reactive you want to be to the market. In other words, the shorter that moving average, okay, the lower the number, the quicker it is going to respond to price changes. The higher the number, the less it will respond to price changes. So if you want a bigger buffer, right? So if Brian got in down in here, right, last November, and he was looking for a move up, but he wanted to sort of trail that stop a little further away. He wants to give the price a little more room for movement. He would use a much larger moving average, okay? Since he's using the 8 and 13, he wants to trail this very tightly. I can tell you that the 8-period EMA, as far as day traders go, is probably as popular as the 20 is with swing traders. It is a very, very popular EMA, and the 8 and 13 is a very common combination, as is the 13 and 34. So if you want to plot a 13 and 34 EMA on your chart and look for that crossing pattern, okay, because that's what most people, when they start out trading, that's what they look for, a moving average crossover system. The 13 and 34 is actually very effective, okay? Now, one of the pros for moving averages, okay, one, they do a great job of identifying momentum or the lack of it. Two, they're an effective use for support and resistance levels, okay? They can, when you use them as a combination, identifying those crossover points. They can identify entry points. They can identify exit points, like Brian was suggesting. Okay? Where the cons come in is that A, they don't work all the time, but hardly anything does. And B, during a choppy market, they're probably one of the least reliable indicators out there. In other words, during a period of consolidation, okay, it's very difficult to make money with a moving average crossover system, okay? Now, there are some ways to get around that, okay? And I'll share with that with you as we go through here. Let's cover the last couple of questions here, and then I'll go on to the next section.
Brian was also saying that another approach that he uses is the 8 EMA low. When the price crosses or closes above, I buy. When the price closes below, I sell. I use this for short-term trading, just as you had mentioned, for day trading, that it is effective. Juan in Middletown said, I'm sorry, Vince, sorry to speak.
Yeah, I just want to elaborate on that.
Go ahead.
Okay, as ideas come to my head, I just want to get it out there before I forget it. So let's change this to an 8. Actually, this is a simple moving average. So you know what? Let me get rid of that and put on an exponential, which is what he's referring to. So moving average, exponential. Oh, no, that's ribbon. There it is, exponential. And let's make this an 8 period EMA. Thicken this up a little. All right. And actually, can everyone see that properly? I'm going to try to lighten this up and see, make this a little more obvious. See if we do a 4 maybe. All right. Can everyone see the white line easily? Okay. So the 8 EMA, again, for short-term trading purposes is very effective. Very effective. Now, as Brian was saying, he goes long when it crosses above. He goes short when it crosses below. What you want to do to make sure you're on the right side of the market with that is to look at overall trend. So in some instance like this, where you're in an overall trend, trend higher that is, you only want to focus on the crosses back above. For you to short here when it closes back below, chances are, just like here, it closes below, right? You're going to get caught. And you take a small loss. Now, the advantage is that because it's so reactionary, because it follows price so closely, that usually if it crosses and it's a head fake or a failed break in that direction and it turns around on you, you usually take a very, very small loss. And that's the real benefit here. So even during a strong trending market, if you were to take a trade in the opposite direction and it goes against you quickly, you're out with a very small loss followed by, a much bigger gain. So it's not a bad thing, but you can see here when the market is not trending, how much more volatile and how much more prone you are to taking losses. And here's the thing, here's one of the keys that hardly anyone thinks about when they're trading moving averages, is look at the size of the candles throughout this stretch compared to the size of the candles here. You cannot trade the same way in this environment compared to this environment. Because what Brian is saying during this trending phase here, everything he's using will work extremely well throughout that phase. Through this phase, not so well. And when you have such wide-ranging candles, your losses during that chop back and forth are going to be much bigger than they would throughout this phase. So whenever you see volatility like that, those big swings, okay, on a daily time frame or higher, that you should interpret as risk, extreme risk. On the flip side, when you see this kind of action on the daily, this is the ideal time to lower your time frame and start looking for opportunities on the lower time frames, because within each bar here, there's a lot of activity. So on a 1 minute or 5 minute, you're going to get some great setups within each bar. Okay. But Brian, the one thing that came to my mind is one other thing you can do to sort of increase the odds or put the odds in your favor, reduce the number of losses you have and increase the number of winners, is to only take the crosses where price on that individual candle closes nearer at its high for long trades or nearer at its low for short trades. Okay. And of course, taking follow through, using follow through as another factor. Okay. So sorry, Raul, I interrupted you. Let's go to the next question.
Oh, not at all. Juan Middletown was saying, Vince, I've been looking for instances of the 20 crossing above or below the 50 to identify changes in direction into a new uptrend or downtrend. The degree of the slope is important as well as the price action leading up to the cross. Do you agree?
Yes, I agree. So again, the overall trend is what really is going to matter most. So let's throw on here well, let's go to a different, there's the 20. Let me add the 50 here. Simple moving average. Let's go to the 50, make this red. Okay. So again, you see when there's a nice strong trend, right? And they're sloping higher. If this 20 had come a little further in here, dip below and cross back above, it would have provided you with a much cleaner, much more obvious entry point and a much better winning trade than you'll get when during a chop session like this, right? So here, it dips below. Yeah, does price head lower? It does, although chances are you would have been stopped out here, back and forth. And even if you're trading with options, for example, price crosses here, or the moving average crosses below here, you buy a put and it goes against you this much, your put's almost worthless at that point. And so even though it comes down here, chances are you're at break even or best, right? That ebb and flow is a real problem for your option value or your sanity as you're trying to manage this trade compared to something like this, okay? So when you have a cleaner mark, you see down in here when it's trending, okay, and it dips here, yeah, it's not necessarily just going to take off right away, but it's much easier to manage and remain in. And the other thing you can do when you have two moving averages like this is just focus on price, not the moving average crossover, the price crossover, like Brian was talking about. So here, both moving averages remained intact. In other words, the 20, which is a shorter period, continues to remain above the 50, right? But price dips below both and then comes back above. So that point where it breaks back above both, right? And especially if it's taking out a previous high, that's a very positive sign. And what you should feel good about is that the 20 and the 50 maintained their current trend. They, it wasn't the price action wasn't volatile enough to bring that 20 below the 50 and then back above. So it's always price you should focus on more, right? You look at here, it dips below, crosses back above, goes on a run. Dips below, cross back above, goes on a run. Dips below, crosses above, goes back on a run. Why? Because throughout the trend was intact, right? The 20, the 50, they remained intact and sloping higher, right? So that's really what matters. That's really what matters, which is why I use the 24 for momentum as much as I do. Now, for you to minimize the amount of chop, okay, one of the simplest things you can do is say, well, I need to see slope on both. So here, the 50 is pretty much flat, right, throughout. From this stretch to here, since late March to the end of May, the 50 was pretty flat. So that helps you avoid most of the chop, okay? So that's one of the things you can do. The other thing you can do is add a third or a fourth moving average. The benefit of using multiple moving averages is that they make the trend much more obvious, okay, much easier to read, just like they make the consolidating areas much easier to stay away from and read, okay? And so let's do something here. Let's get rid of these, and I'm just going to put on what we call a moving average ribbon, okay? All it means is a bunch of moving averages on at the same time. Now, Thinkorswim has here moving average exponential ribbon, okay? It doesn't matter if you're trading with a different charting platform that doesn't have this, you just want to go on and throw a bunch of moving averages on yourself. What this ribbon consists of is it starts with the 10 period moving average and it goes up by tens. In other words, it puts the 10, 20, 30, 40, 50, 60, 70, 80, 8 of them on, all 10 points apart, and they're all exponential. You can make them simple. It really doesn't matter. Okay. Actually, I should thicken that. I'm not going to bother wasting time with that. I hope you can see it. So you can color them any color you want so that you have a clear understanding. Here, what they've done is they've made the shorter term moving averages a little darker and the longer term a little lighter. The whole point is, if you look at this, when they're stacked appropriately, so the 10 is over the 20, 20 over the 30, 30 over the 40, etc. When they're stacked appropriately, you've got a nice strong trend in that direction. When some of the moving averages are overlapping, that's where the chop zone is. And so if you look in here, now during that April, May area, right? Just having that one rule saying I'm only going to trade when the moving averages are stacked appropriately. If they're not stacked appropriately, it means we don't have a trending market. So that one rule would keep you out of this whole area here where you would likely just get, eaten up by the chop and take several losses. Okay. So and it really makes these areas where price dips into the ribbon and back out very obvious, right? You dip into the ribbon and back out. Okay. So the key here is that the lines never overlapped. That's the real key. If you look at this, even the 10 period moving average, it never crossed the 20 or the 30, or it went flat itself, but they all stayed in the right order, which means the trend is fully intact. When you see price dip below and back above, chances are it's going to take off. And before we get to another question, the last thing I will say is that if you use a moving average crossover system, okay, and you can use any. Let's, for example, look at the, here I have the 50 and the 200, but you can use the 8 and the 21. You can use the 8 and 13 like Brian had. You can use any combination you want, okay? Let's go to a longer time frame here. Let's put on the SPYs, for example. Okay, that's not even a good example. What else can we use here? Let's say Nike, maybe. Nope, that's been trending too well as well. Yeah, maybe I should shorten these, make it a little more obvious. Okay, bear with me for a second. I'm going to make this the 20 in red, and let's do the 50 in black here. Okay. So if you're looking to short when the 20 crosses the 50 to the downside, or go long when the 20 crosses the 50 to the upside, and again, it could be the 813, it could be any combination. But when you have two moving averages like that, one of the things that you can do to just make sure you're not getting chopped around, okay, is to wait that, and once you see that cross, to make sure it takes out a previous high, okay? So if we crossed in this area down in here, there was price, right? Where's the most recent high above these moving averages? Well, it's up here, okay? So this here is actually the safe area to trade, right in here, right? Now, it pulls back, it doesn't cross it, it pulls back, and now it bounces off it again. Now there's this previous high, so you can at least say, hey, once that high is taken out, now I'm in. That'll allow you to get in a little earlier. But really, the safe area was when a previous high was taken out, okay? And I mean, if you go through a stretch like this, even though the moving averages are intact, okay, one over the other stacked appropriately, it's still an area of consolidation. You can still draw a channel. So you got to be on the lookout for these. So it may fool you the first time or the second time, but once you see minimum of 3 points, 2 on one side, 1 on the other, you have a channel building. So you want to wait until you get out of that channel. And once you get out of that channel, you're safe to go again. Okay. You can also combine, candlestick formations and other things that happen right along those moving averages. But a crossover system, you should always wait to break a previous high once that cross comes through. It'll help you avoid a lot of the chop.
Ash in Farmington says, Vince, how about 8 and 34 EMA with an RSI length 20 and overbought and oversold at 50?
So all those things are going to work. Not all the time, but they will work. What you want to do is go back and look at the times that they don't and try to understand why and maybe tweak it a little. Okay, so if we look at the 8 and 34, okay, here, let me just quickly put this on. We'll leave the 8 red, put the 50 down to 34. And I'm sorry, what was the RSI setting that they used?
20.
RSI 20. Okay, so let's bring on an RSI. Let's change it to 20. Okay, let's make it easy to read. Okay, shrink this if I can. So when now I don't remember what she said about which lines to use, oversold or overbought or that sort of thing. It doesn't really matter. Here's how you combine moving averages with other indicators, whether it's RSI, CCI, MACD, it doesn't really matter. You want to look for, or you want to use these other indicators as confirmation. So if you were looking for a moving average crossover system, so say when the 8 crosses above the 34, I want to go long, but what can I use to confirm that that's not a head fake, right? So if you're going to use the RSI, crossing the 50 line, let's say, yeah, that would have worked right in here. It went from below that 50 line above. Okay. If you want to wait till it's in an overbought situation, you can do that. If you want to wait for it to come out of an oversold situation, you can use that. They're all going to work sometimes, but not other times. Okay. The basics should always be there, meaning you really don't want to focus on the crossovers that happen when moving averages are totally flat. Okay. See here, when that 34 was sloping significantly higher, if this 20 pulled back a little more and dipped below and back above, I'd much rather take that setup than this setup down here. Okay. Because the 34 is telling you have a much stronger trend at that time. Okay. So those are the kind of things. And then if the RSI or any other indicator reinforces it, then even better. Okay. But whether it's the 8 and 13 or 13 and 34 or 8 and 34 and RSI, CCI, they're all going to work some of the times. What's most important here is you, the trader. Okay. The reason why I showed you that 137 period moving average to begin with is to prove to you that any number you throw on there, the price is going to hit it at some point and make some charts look like it works. For you to be a consistent trader, you need to believe in the system and you need to be able to follow those rules. Okay? So you need to find what works for you, what's comfortable for you. That's the main thing. You don't overcomplicate it. So if you like to use the 8 and 34 with the RSI, fantastic. Use it. The one question you have to ask yourself is that when you get that setup that you're used to using, if you're wrong, okay, and it doesn't work that time, how are you protecting yourself, right? How are you preventing the loss from becoming a big loss? If you can do that, then there's nothing to worry about. See, the actual moving averages you use or the other indicators that you use, that combination, they don't always make all the difference. Sure, that some are more consistent than others and they'll help, but the rules you wrap around it or how you execute those orders, that's what really matters. So as long as you have a way to prevent this from becoming a big loss, if it is a loss, okay, and allowing it to run when it wants to run, that's what ultimately matters. And that is up to you, the trader, and the rules you wrap around your system. okay? So that's why I say you have to find what you're comfortable with. The reason why I'm doing this whole session is because for the most part, most traders are very comfortable with moving averages. It's just something that visually is easy to understand and is very comforting to most traders, okay? And I'm the same way with the 20, right? I love using the 20, but if I say to you, follow the winning momentum strategy, okay? To me, it's just as simple because I'm giving you step A, step B, step C, right? Look for the slope on the 20, look for which side of the Ichimoku cloud you're on, and then look at the RSI for a cross above or below that 50 line. Very simple rules to follow, but you'd be surprised how many traders would not be able to follow that, but would be able to say that if the 8 crosses the 34, I go long, and if the 8 crosses below the 34, I go short. It's just something that is very easy for people to follow. And so that's why I wanted to do this session. So if that works for you and it's easy to follow, perfect. Stick with it. But you always have to ask yourself that question. If this does not go my way, how do I prevent it from becoming a big losing trade? And if it does go my way, how do I allow myself to take a big profit? Those are the two most important questions.
Let's go to Sandy in New Jersey, who's going to be providing us with a World Cup update shortly. He says, Vince, your comment on using moving averages that other traders focus on, the one where you said, I sometimes hear that it's better to be slightly off so as to avoid the, quote, crowding effect. So would you use the 19-day instead of the 20 and the 49 instead of the 50? Is there any merit to this argument?
No, I don't think there is. First of all, you want to know where other people are looking or placing their orders. It doesn't mean you want to follow along and do exactly the same thing, but you want to know what others are looking at. And displacing it by a point or two isn't going to be enough. If you want to do something different, you got to go even further away. So, taking the 20 to a 19, that's not going to do anything. Using an 8 compared to a 20, yeah, that will. Using a 34 compared to the 20, that will, that sort of thing. But I think you want to know where others are looking. So I would tend to stick with the more common ones.
Our friend Spiros in New York says, Vince, can you repeat again the moving average combinations for 813 and 1334? I think those were the numbers. Are they simple or exponential? Thank you.
Again, it's up to you. Most of them are exponential because those moving averages are usually used on the shorter time frame, especially the 8 and 13. The 813, 821, those are very common day trading combinations, and they're used with exponential. The 1334 is one that is very common on daily charts, and it can be either simple or exponential. It's really your choice. I would probably lean towards exponential on those combinations, but the lower your time frame, the more of an argument there is to go exponential. Okay.
Everyone is thanking you for the green ribbon tip, including Juan. Thank you for the comments, Juan. Brian in Linwood was saying, Vince, how do you put the 50 line on the RSI?
So you just go into the settings, and so I'll show you how to do it on TOS, but it'll be similar on any other platform. You're going to have an overbought line and an oversold line, right? Usually the defaults are either 70-30 or 80-20. What you want to do is use one of those for the 50 line. So I'll use the overbought, and so I'll drop that to 50, right? And then you want to remove the oversold. So on Thinkorswim, you just click on the oversold tab and uncheck show plot, and it gets rid of it. On others, an easy way is to change the color of the oversold line to the same color as the background of your chart. It'll disappear, and now you've got a 50 line right down the middle. So you see when the RSI moves below the 50 line, it tends to drop. When it goes back above the 50 line and remains there, it tends to trend higher. So I don't generally use the overbought and oversold. I tend to use the midpoint line. It's something I found out many years ago. But when people start out, what they usually do is look for an oversold level and look to buy when it comes out of that oversold level, and then tend to look for a sell when it goes overbought. I look at it as the opposite. If you can go overbought, it means there's a lot of momentum behind that. And I think that's another great area to go long when you're overbought, because it tends to stay overbought because of that momentum move. But the 50 line, I think, is the most effective.
We're just about 10 minutes to the hour. As always with these courses of the month that we do, we always overestimate how quickly we can do them. And I don't think we ever get all the content done in one session. So we may have to break this up into two again.
No problem. I don't mind staying a little longer. I've got a couple other points that I want to share with you, but the most important thing is that we cover all the questions.
All right,
So,
Sam, Katie, Texas. I know we're talking about moving averages, but one of your favorites, which I use, the RSI, I have found that using the RSI, the 750, along with the MFI, the 50, 50, 3, and 3, when the RSI and the MFI cross the 50 bar simultaneously, it seems like it's a strong signal of movement.
let me see if I can throw one on here. Again, if you have found a combination, that's great, and thanks for sharing. That's great. Is it the money flow MFI here? Money flow index. And you said, what were the, I think you said 50, 50 something. What was the third one?
The RSI was 7, 50, and 50, and the MFI was 50, 50, 3, and 3.
50, 50, 3, and 3. Okay. So that's great. Thanks for sharing. Let's quickly, 3. Oh, sorry, I need to change the RSI. Sticking this up. Bear with me for a second here. And RSI was a 7. Okay. So when they're both crossing, you're saying it's effective? Yeah, I mean, and that's great. So when you find something like that, it's very effective. Another thing I will tell you is extremely effective, okay, is multiple RSIs with different settings. So if you were to put on a 7-period RSI, a 14-period RSI, and a 21-period RSI, okay, to me, that's like looking at the daily, weekly, monthly, okay? So if you plot them all on, and when they all cross that 50 line, and it doesn't have to happen on the exact same candle. What I mean is the first candle where all 3 of those RSIs are either above that 50 line, or below it, that's usually a great area to go long or short. Okay, so have a look at that. I think you'll be impressed if you put on the RSI 7, RSI 14, and RSI 21, all 3 with a line drawn at the 50 level, and look for that first spot where they are either all above that 50 line or all below. You can see how effective that is. So, and then, you can use a moving average like the 8-period moving average to follow it along. Use it as a trailing stop. Okay, the 8 moving average. My friend Stephen Bigelow uses the 8, and what he says is that when price moves above the 8, it tends to go on a run. He calls it the 8 bull run. Okay. And as long as it doesn't dip back below the 8, you got a strong move on your hands. Okay. So when you have that area where your indicators are suggesting an entry and it's crossing above the 8, an easy way to follow it visually is just as long as it remains above the 8, you're in. As soon as it closes below, you're out, right? Now, you can also, one of the things you want to do is if it closes below, you mark that low and then exit on the follow through, right? Because it could just pop right back up above. But that 8 moving average for an exit strategy is fairly effective.
John in Chicago was asking, Vince, how are exponential MAs actually calculated?
So and let's say here, if we had an 8-period simple moving average, it would count back 8 bars, right? And average out the closing price of those 8 bars. And that's where it would plot the line. The exponential means it's giving more weight to the most recent candles compared to the further away candles. So it's still going to take the last 8, but for the most recent 3 candles, it's going to provide more weight there in the calculation than it does to candle 8, 7, 6, 5, and 4, for example, right? So if the price has a sharper move recently, the slope on that line is going to change more quickly. Let's do this. Let's go in so I can show you the difference. Let's go in here and change this. Oh, actually I can't. It's the same. Let's get rid of 1. So this is simple. Let's put on an exponential, moving average exponential, and make it 8 as well. Okay, thicken it up. So you see the difference? Okay. So see, the green is exponential, right? The red is simple. They're both 8-period. Okay. So the green reacts a little quicker. That's all it does. So when you're day trading, right, you're going in and out much quicker, right? Much smaller moves. So you want a quicker reaction on that moving average. Okay. So you want to use exponential with a lower time frame. Higher time frame where there could be a lot more ebb and flow with the price, you want to give it a bit more of a buffer, so you want to go with a simple.
Okay, I think we are good for questions for now, so why don't you continue?
One other thing I want to show you. Have you ever heard of the Guppy multiple moving average system? Have any of you ever heard of the Guppy multiple moving average system? Basically, okay, Melanie says yes. I want to throw it out there again because this is something that may provide you some comfort. It doesn't mean it's necessarily more effective than anything else, but it's like combining 2 sets of the ribbon that I showed you. So here I put together a layout ahead of time so I can show you. So you have 2 ribbons on, the blue ribbon and the red ribbon. The blue ribbon has shorter term moving averages. The red ribbon has longer term moving averages. Okay, so these are all EMAs, not simple moving averages. They're all exponential, all of them. But the blue ones are 3, 5, 8, 10, 12, 15. So they range from 3 to 15, very short term moving averages. The red are 30, 35, 40, 45, 50, and 60. Okay. They're higher term moving averages. Now, clearly, you can see that when they are all stacked appropriately and both sloping higher, then we have a very, very strong trend. Okay. And I mean, for price to be above the 3-period moving average, consistent, there's a lot of momentum there. Okay. So this generally, you can use it where if price dips into the moving averages and then pops back out, okay? If they're all stacked appropriately and they're all sloping properly, etc., great spot to get in, okay? This is a daily chart and it's on a stock that trends well. I'll show you others that don't. The other thing though, the way this is really meant to be used is if the blue ribbon dips below the red and crosses back above, for example. So you want to think of the blue as one moving average and the red as your second moving average and use it like a crossover system. Okay. So let's go back to McDonald's maybe. Okay. This is the daily. Been very choppy lately, but you can see that with that chop, the moving averages are sort of all over the place and all intertwined. We're making it more obvious that you should stay away from this area, right? You only want to focus on the strong trends. I like to use it on a higher time frame. To me, this is sort of like, you get a stock that's beaten up and you're waiting for a bottoming formation, right? you want to know that you're in the clear, that this has turned the corner. So traditionally we look for higher lows, higher highs. We look for double bottom formation. We look for all these sorts of things, right? This is a very simple way where if the shorter term moving averages have all moved across the higher term, you know that buyers have taken control, okay? So it's a very simple, easy way to spot that turnaround on a higher time frame, on a longer time frame. This is the monthly. Okay. You still want to look for the same things. You see in here when it was going sideways, the blues are not stacked appropriately. They're all one over the other, right? They also make it very simple to spot those highs. So if you want to take a break of the highs, it's very clean, very easy to spot. And when it does, they're all stacked properly. Both sets are trending strong. They're sloping higher, and you got a nice run on your hands. Okay. Juan is saying, what were the time periods for the shorter guppy ribbon? They are 3, 5, 8, 10, 12, and 15. Okay. You can modify them slightly. It really doesn't matter. It really doesn't matter. You just want to use a shorter set and a longer set. Okay. And the higher ones were 30, 35, 40, 45, 50, and 60. Avery, to put these on, I actually just had to go in and plot each one individually, and then I saved it as a layout, so I wouldn't have to do it here and waste time during the presentation. Another easy way is to plot the ribbon. If you are using Thinkorswim or a charting platform that has a moving average ribbon, like here, moving average exponential ribbon, and you add that on, okay, you want to go into the settings of the ribbon and then see here, this is one, the second one, the third, the fourth, the fifth. Just go in to each one and change the length, change the multiplier and so on, and just do it that way. It'll be quicker. But just do it once. Plot the 3, 5, 8, 10, 12, 15, and the others, and save it as a layout. Okay. Any questions?
I think we're okay for now. You've answered the question for the shorter guppy ribbon. What else do we need to know about for moving averages?
Just remember what they're really used for. Number one is to judge momentum, right? That slope, super, super important no matter which moving average you're using. Secondly, support and resistance. So you can see as price moves back against it, right? Your first ribbon, that's your first level of support. Your second is your second level of support. If price breaks below both, chances are it's going much lower, right? And whether this is one moving average or a ribbon of moving averages, it's used the same way, okay? So, and always apply it with the basics, right? So if we pull back here into the moving average, but we're also, say, at a previous high, right? That's added support, right? That's even an even stronger level of support. If that pullback lands at a proper fib level, that's more support in that area. So that's another way that you could use the other tools that you have. So you're looking for any area where the moving averages are all stacked accordingly, all sloping higher, and you're waiting for an area where price is moving into the moving averages and then popping back out. Now you're going to see that over and over and over on many, many charts. How do you differentiate one from the other? How do you take the higher probability trade? Well, one, you can identify slope. If one chart has a much sharper slope on the moving averages, that's a bonus, right? Another thing is that if you pull back and you plot your fibs, right? Take the most recent low to high, and it's come into that zone, that 38.2 to 61.8 zone and bouncing out of it, chances are that's a much stronger area of support here, and you have a much better chance that this is going higher. So if the other chart you're looking at, it only pulled back part of the way, hasn't come in and bounced out of a significant level of support, it's not as strong, right? So these are all things you can compare. But the bottom line, like I said earlier, is you have to find what you are comfortable with. For some of you, the ribbon is going to be fantastic, okay? I can tell you, for me, on a monthly, using a ribbon, I don't know, it just feels good. It just feels right, okay? And I much prefer to use a regular moving average ribbon than the Guppy system, okay? I'm going to put this ribbon back on here, right in here, and, well, actually, I'll just leave it the way it is, and remove everything else here. I mean, there. On a longer term chart, to me, when price clears the moving averages and trades above it or below it, it's just so clean and easy to read. I mean, if price breaks a previous high here, right, and stays above that shortest moving average, I mean, why would you want to get out, right? It's so simple and easy to follow. That's just me, right? It's a personal thing. If it works for you, great. But that's how I would use moving averages. Okay?
Brian and Linwood, Vince, is there a most common time frame that's effective for day traders?
I think the most common is the 5 minute, but there's a real range. I mean, the 5 and the 15 are probably the most common. I've known guys to trade with a 30-second time frame. It really doesn't matter, but 5 and 15.
Are there some personalities that are better suited to day trading than others?
Yeah, if you really want a lot of action, if you don't have a lot of time to spend in front of your screen, that's what I think the real difference is let's say you have 2 hours today to trade and nothing else. Trading on a daily time frame when you have 2 hours, I mean, you can find a setup, place your order, and walk away. That'll take all of 5 minutes. There's nothing else to do during those 2 hours. But on a 5-minute chart, you'll probably find that several trades to go in and out of during those 2 hours. So that's the real difference.
Okay. Any other questions with which we can challenge Vince? Otherwise, we're just about 10 minutes past the hour. Vince, those questions were answered really quickly and well by you. So I think we've gone through most of them. If there are any others, we will take those now. Otherwise,
I see one from Brian. He says, what were the settings for the ribbon again? This particular ribbon on Thinkorswim defaults to 10, 20, 30, 40, 50, 60, 70, 80. So it starts at the 10 EMA and goes up to the 80 in increments of 10. It really doesn't matter. One other thing I've seen and used in the past that's effective is you can actually use the Fibonacci levels as your moving averages, right? You know how if you plot the Fibonacci's, you get the 23.6, the 50, right? The 61.8, the 76.8, 100, etc. So you can do the same with the moving averages. You can do a 23 moving average, a 50, a 61, a 76, a 100, right? 127, 1618, right? It doesn't really matter all that much. What matters is that they're stacked in the right order, because when that happens, it means the underlying instrument is trending strongly in that one direction. And that's all that matters to me. Okay, that's what you want. Trend and momentum behind every trade. Okay, whenever one of those is missing, your chances of taking a loss are much, much higher than they otherwise would be.
Juan says, excellent session, gents. Appreciate the gift of your time. Always. Juan, thank you so much for joining us. Russell in Houston, thanks, Vince. Great course today. Sam and Katie, Texas, Vince, regarding day trading, do you tend to stay with one or two equities or several? And Juan was also asking, are exponentials better for short-term trading and simple for longer-term trading, simple moving averages?
Yes, so exponential for shorter, simple for longer. And when day trading, I usually have max 6 charts up, 6 different equities I'm looking at maximum. The fewer, the better. Okay, as you get comfortable and quicker at it, and more familiar with whatever setup you're using, yeah, you can bring in more charts to keep an eye on. But for me, the more I have that I have to keep an eye on, the more of a distraction it is, the more susceptible I am to making a mistake or missing a setup. So start off with 1 or 2, try to work your way up to 4, maybe 6, but usually not more than that.
I suspect once you've had a chance to digest this information, there will be some follow-up questions. We always love to hear from you. info@tradingwinds.com, and we'll be happy to answer those questions for you after the session.